All right, you degenerates, settle down. Welcome back to the Big Short Club. We're skipping the rubbish intros and getting straight into the alpha. I'm Chris.
And I'm Morgan. Today, we're dissecting the heavy artillery of technical analysis, the absolute strongest reversal patterns, the stuff you're meant to learn for your CMT Level 1, but we'll give you the street-smart version.
Exactly. This isn't some dusty library lesson.
Right.
This is about spotting these setups in the crypto Thunderdome and not getting your account blown to bits. First up, the undisputed king, the gaffer, the head and shoulders pattern.
Ah, the one every new trader proudly draws on their chart with a digital crayon, usually incorrectly. Go on, Chris, break it down for the people at home.
Oi, you and your CFA charter can get stuffed. Look, it's dead simple. The market's in a proper bull run, yeah? It makes a peak, that's your left shoulder, it pulls back a bit, then the FOMO army gets a second wind, they all ape in, and they ram the price to a new higher high. That's the head. But they're knackered, completely out of steam, the price tanks again, the last of the buy the dip believers give it one more pathetic push, but they can't even get back to the last high. That weak little peak is your right shoulder.
And the linchpin of the whole setup is the neckline.
Bingo! You draw a line connecting the two low points, the troughs, between the shoulders and the head. When the press smashes through that neckline, it's lights out for the bulls. The party's over. That's your higher probability signal the trend is flipping. It's as close to a dead cert as you're going to get in this game.
From a quant's perspective, what's compelling is the measurable objective. The distance from the peak of the head down to the neckline gives you a projected price target for the reversal.
Right.
It's not just a vague feeling that it's going down.
Right.
It's a data point. It provides a logical framework for your risk-reward calculation.
See, even the suit gets it when you talk his language. It's not just pretty shapes. It's a story of a power struggle. The bulls threw their biggest punch and missed. Now, let's talk about its simpler but just as brutal cousin, the double top. Cheeky. The M for mugged off.
Or M for Morgan, the guy who reminds you to maybe check the company's financials before you YOLO into a coin that has just failed at a major resistance level twice.
Bore off. A double top is even easier to spot. Press smacks into a ceiling, gets smacked back down. It finds some new buyers who think they're geniuses for buying the dip, and they run it right back up to the exact same level, and denied. Brick wall. That M shape on your chart is the market screaming, we don't have the horsepower.
Right.
Emphatic, the real signal fires when it breaks the low point, the valley between those two peaks.
And its inverse, the double bottom, shaped like a W for winning, is arguably one of the cleanest bullish reversal signals you can find. After a long, painful downtrend, the market tries to print a new low, bounces, sells off again, but crucially holds that same support level. It's a visual confirmation that the sellers are exhausted. Buyers are finally drawing a line in the sand at that price.
And listen up. If you spot a triple top bottom, mate, that's the holy grail. That's a 5-star A+ setup. The market has tried 3 times to smash a level and failed every time. The reversal from that is usually biblical. But here's the key, and don't miss this. Seriously, you have to be patient. Don't short the second top, you'll get faked out. You wait for the confirmation, that break of that support neckline. That's your trigger.
I think that's the most common and costly mistake traders make.
It is.
They anticipate the pattern's completion rather than reacting to its confirmation. They see that second peak forming and they load up on shorts. Only for the price to rip right through it and leave them liquidated.
That's how you get wrecked. Simple. You wait for the market to show you its hand. Let it prove the pattern to you. Right, now for a proper sneaky one, my personal favorite. The rising wedge. This one is pure, unadulterated treachery.
Okay, I'm intrigued. Enlighten us.
So, look at the chart. It's making higher highs and higher lows. Looks mega bullish, right? Everyone's piling in thinking it's going to the moon. But if you draw the trend lines connecting the highs and the lows, you'll notice they're squeezing together. The upward thrusts are getting smaller, weaker. The buying momentum is fading away.
Right.
But it's cleverly disguised in this slow, grinding upward channel. It's a bear in wolf's clothing.
You're describing a compression of volatility within a clear uptrend.
Yes.
The price is coiling like a spring.
That's the one. And when it finally snaps and breaks that lower trend line, our drop is usually vicious and rapid. Why? Because every single person who got long inside that wedge is now trapped underwater and scrambling for the exit. It's a textbook bull trap. The fall-in wedge is the opposite, a slow, painful downtrend that looks like death,
Yeah.
but is actually coiling for an explosive breakout to the upside.
This is where paying attention to volume becomes absolutely critical. In a rising wedge, you will almost always see the volume diminishing as the price grinds higher.
Exactly.
Pointed, that's a massive red flag. It tells you there's no real money, no conviction behind the move. Then on the breakdown,
In boom!
you'll see a huge spike in volume. That's your confirmation.
Spotter. The volume is the footprints of the whales. Follow the volume, always. Dramatic. Right, last one, the rare beast.
Oh,
Island reversal.
the one that leaves your portfolio stranded on a desolate rock.
You got it. Paint the picture. The market's on a tear, let's say an uptrend. Then one day it gaps up, a space on a chart we might trade in. It trades in a tight little cluster for a few days, totally detached from the price action before it, and then it gaps down.
Wow.
Leaving that little group of candles all alone at the top like a tiny deserted island.
That cluster of trading is the island.
Yeah.
And the empty space on either side, the gaps, is the water.
And that, my friends, is one of the most violent and definitive reversal signals that exists. It's rare, but it's pure poison for the prior trend. It shows a sudden, complete 180-degree flip in market sentiment. The bulls were so euphoric, they literally jumped over a price level to get in.
Right.
But then something changed so dramatically that the bears took over and jumped right back down. It's game over.
The psychology there is profound.
No.
It isn't a gradual transfer.
It's not.
It's a complete and total abandonment of the previous narrative. If you see that pattern forming, you do not argue with it.
Absolutely. You do not argue with it. So there you have it. The head and shoulders for its textbook reliability, the double and triple patterns for their blunt force clarity, the wedges for their sneaky traps,
Right.
and the island reversal for pure shock and awe. Master spotting these and you're already playing in a different league to 90% of the Muppets on social media.
But, and this is the most important part, always manage your risk. No pattern is a crystal ball.
Gospel.
Every single one can fail.
Gospel. All right, that's your lot. Before you go, don't forget to dive into our free chat group. The link's down below. We're in there talking charts, calling at setups, and having a laugh all day. Don't be a stranger. Now, here's a question we'd like you to think about for next time. We've talked about these patterns as distinct signals, but how often do you see them combine? For instance, could the right shoulder of a head and shoulders pattern also be one half of a double top? And if so, which pattern takes precedence? Chew on that. Catch you on the next one.